You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone, give us a call. We can get emails as well, info@malibufunding.net. Malibu Funding is the company that sponsors the show. I want to thank those nice people for doing so year after year after year. It's really nice, and we get to come on the air and explain to you some things that you might not know. I've been doing a lot of work on LinkedIn. Anybody out there work on LinkedIn or use the social media network, which is strictly for business or is supposed to be? I am trying to reach mortgage professionals, real estate professionals, and people in the trades, escrow, title, inspections, anything else you might be able to think of, credit people. Reason is that I have a great need to know more and know more about what goes on in our industry is really the only way I can bring things to you. So I talked to an escrow officer today out in the Temecula area, so we're going to have her on in the next couple of weeks. But one of the things that she was talking about, and I think it's really interesting, is that because the industry has slowed somewhat, a little bit, right? We've seen it in real estate, i.e. that the prices have stopped skyrocketing. And I think last year we were saying nationally, not we, but the NAR, National Association of Realtors, were saying that the price in real estate is about 5% gained last year nationally, which is down, right? It was 6.5% the year before. In pockets around the country, you see prices that have remained high, but for the most part, in our general area, we have 6%, 5 to 6%, which is something that can be sustained. But in this shrinking marketplace, less buyers, interest rates are somewhat higher, although we'll get into that later on in a different segment about what the interest rates are and where they're going. She was talking about expansion of services, because as a escrow company, you are only viable if you have volume business. It's the type of business, and every transaction, whether it's a refinance, whether it's a purchase, whether it's any number of other services that they provide, it's a high volume, low cost deal. Now, in purchases, of course, it may be higher cost than a refi. Obviously, there's more to it. But all these services that they have are negotiable, and I don't know of an escrow company or a title company that won't negotiate their fees. Absolutely, they all will. But in a shrinking marketplace, she talked about expansion of what she does, and she talked about what services she gives to investment opportunities and to investment buyers and sellers, which I thought was interesting in that she is out there hoeing the field, so to speak, with me on LinkedIn to try to see if she can expand what she does as an escrow officer. Very interesting person, as a lot of people are on LinkedIn. We've probably emailed about 1,000 people, let's say, in the last month on LinkedIn. And we're looking to try to get interesting people like this escrow officer for the show to be able to explain to you what the services that they offer, where they work, and what their stories are about what's going on out there in the marketplace. It's really the only way we get to understand firsthand what a loan officer is experiencing, what a real estate agent is experiencing, and anybody and everybody in between. So we want to bring that to you each and every week, and we're out there trying to do that as diligently as possible. There are other things that we do to bring guests to the show. I have an extensive background in the business, 20 plus years in mortgages and real estate. So drawing upon that, plus a lot of new people, a lot of new experiences. One of the things I want to ask, and I'm going to bring Daryl in right now, is of the things you do today, can you compare it to when you grew up? Is there anything that you do today which is a direct correlation, or anything you did when you were growing up that's a direct correlation to today? What do I mean by that is, when I was a kid, my dad read the newspaper Nobody reads newspapers today, right? When I was a kid, there was a telephone that you picked up and you actually hung up. That's a term a lot of millennials and younger people don't know. But what in your life do you see that still is today, or is there anything?
Very little. I mean, I still go to the barber, and I still tell him to do the same thing to my hair that he did when I was 10 or 11 or 12, I think.
Okay.
But I remember getting blue chip stamps and saving up enough of them to get a television, because we operated as a family without a television for about 2 years because it broke down and we couldn't afford to buy another one.
Right.
So we were collecting these stamps that you put in a book and you took
Right.
down to the redemption center
Sure.
to get that. But, there are very few things actually that reflect from those years and days on what we do now.
Daryl runs. He works in radio and has for his entire adult life, for the most part, and knows more about radio than I can remember. Radio is one of those mediums that everyone's trying to convince everyone else that it's dead, it's not working anymore. But radio, even radio itself, has changed dramatically.
Well, most artists say that the first time they heard their song on the radio was the big turning point for them, that they knew they were going to be a success. Mm-hmm. The country music stars still thank the DJs for playing their records on the radio. I think radio is still relevant. I think it either is a primary source or a source that enforces your thought. Right? It's top of the mind awareness, and radio can say, if somebody picks up a newspaper, right, there's no guarantee that they're going to look on every page of the paper, right? If you've got information in section B, page 12,
right,
people reading the paper may not get to that, but if you're listening to the radio, you will hear everything on that radio station.
Yeah, you have to.
Right.
It's a captive medium.
Correct.
Right.
And so I think that it fulfills that responsibility quite adequately.
Well, why I bring this up, and this leads to real estate and in the mortgage business, is because everyone has parents or grandparents. Hopefully, most people have them still around, and their world and what has happened to that world. Now, I'm in my 60s, so if you're younger than me but you have grandkids, great. If you're older than me and you have grandkids, great, or kids or whatever. But to experience what you experienced in your lifetime, and then get to a point, 60s, 70s, certainly 80s and 90s, where those things that you used to value are no longer of value. The difficult period for most people is to understand that that's true. That's why you find most older people talking to themselves. Why? Because there's nobody around who knows anything about what they've experienced in their lifetime. Who are they going to talk to about what went on in the 40s and the 50s? There's nobody around. So when they transition from owning a home or living in an apartment to assisted living, or they sell that house that they've lived in and raised a generation of kids, and they have to move, that's a traumatic experience.
Well, especially to go from lots and lots of space. I mean, my family, my roots of my grandparents are in Iowa and on Nebraska and places like that, where they grew up on farms where there were acres and acres and acres of places to be, and then to be restricted to, like in a retirement home or a convalescent hospital, to be restricted to like one room has got to be such a drastic change.
It's unbelievable. I watched my brother. Now, he was in his early 60s when he went into a home. He was early onset Alzheimer's. And to deal with that as an older person, and then as the siblings or, the children or spouse of somebody who's gone through that and going through that, selling the real estate is traumatic in many respects. Trying to understand the processes of how things are communicated nowadays, and anybody who's around now that was around 10, even 15 years ago can tell you that the way people under 30 communicate is not the way we used to communicate. It used to be a telephone, and that was it. And then maybe a fax, or maybe an email. Now none of that counts.
I was submitting bids to the Navy via teletype until about 1984, 85.
Teletype. Another thing, telegram, teletype, anything having to do with, communication lines. So I just wanted to bring that up just to know that we've got a scale down and a scale up market where people either step up to a bigger house or sell in order to get in. For older people, it's that much harder. Just be aware in the marketplace. That's what's happening in a lot of markets out there. So I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. If you pick up the phone, give us a call. We can help you with your mortgage questions. We're talking in an earlier segment about growing old, things that have changed from the way they were to the way they are, and how to deal with that, especially when you're buying and selling real estate at later stages of your life. If you have comments about that, you can email me to info@malibufunding.net. And certainly, if you want to see this particular show, we record the show by a video for the feeds for KCAA and KMET out in the IE, Inland Empire, San Bernardino, and Riverside counties. I want to say hi to everybody out there and thank those fine radio stations and the people. Both KMET and KCAA have FM outlets, so we are on at least 5 times a week out there. Please tune in and listen. Also for K-Tahoe, up in the Tahoe area, bunch of snow up there. Daryl, how much snow they gotten recently?
Probably about 2.5 feet in the past 4 weeks.
Unbelievable. So if you're a skier, California is the most diverse state. You can ski in the morning and surf in the afternoon. Now, that is something you can't do almost anywhere. But enjoying California and what we do is great. But those radio stations, thank you again for showing. And KTBD, we have any word?
We have a competition.
Oh, excellent. I like competition.
We have a competition. The winner will be announced in the next couple of days.
Excellent. Very good. And that's for our upcoming New Mexico affiliate. And I really appreciate bringing on new affiliates. We're going to do a couple more of those this year, so stay tuned. If you would like to see this show on YouTube, go to YouTube, my channel, Jeff Barton, The Real Estate Voice, and you will see hundreds of shows there. This one will be up in a couple of days. Anybody that you see on that you want to contact, we try to put their picture up on the show with their phone number underneath, email address, company they work for, things like that. The number of times that we have had people calling and asking for guests happens a lot. So, yeah, that's where you can see, and we archive almost everything. So let's get right to our next segment, talking about America's debt load and what that portends for the future. We have some interesting, there are so many things that come out in the news, and Daryl, you may have heard this, that the wall is going to be partially built. The shutdown's probably not going to happen. Nobody's happy, but it gets worked out, right?
Well, I've heard that both houses and both the Democrats and Republicans have agreed on something, but I'm not sure that they're going to get a sign-off from President Trump. Well,
I think there is. Nobody wants that shutdown because, let's face it, it was hurting everybody, and the person getting blamed.
He doesn't want to wear that.
No, nobody. Again. Exactly. I mean, it's just silly because, you either negotiate something, which is legislation, and then the president signs or he doesn't. But to hold the country hostage because you don't get your way, all that. But that is what is happening. But like I was saying, there's always a little good news, a little bad news. So the bad news is about U.S. debt. The U.S. debt is unbelievable when it comes to credit cards, automobiles, mortgages. Guess how much the actual debt load is on the American public. Do you know?
You mean by dollars or by percentage?
By dollars.
Oh, I would have no idea.
$13.5 trillion for the fourth quarter 2018.
Wow.
Risen consistently since 2013 when debt bottomed out last recession. Okay, it's unbelievable. Now, why I bring this up is because the economy, a lot of people are a little concerned about what's going on with the economy anyway, right? I mean, there are positive signs. Obviously, the employment is unbelievable. We are employing more people now than we ever have, depending on where you stand and the type of employment it is can be argued. But they can't be argued is the number of people working, the number of people who want to work, can work. Those numbers of the people who want to work are actually growing. Now, why is that? Because for 10 years, a lot of people just gave up looking. But now, since employment is really at its lowest levels for almost 20 years, maybe more, the amount of people who are looking for a job is growing because all these people are coming back into the marketplace, which is a good thing. The debt load, however, indicates that people are continuing to live beyond their means, meaning, and I don't know why this happened, but it did happen. There came a time where debt was considered something that everyone had to have, okay? Mainly your mortgage. The mortgage on your house is the largest debt you will ever incur. However, the second largest debt would be your automobile loan or your credit cards. When the Fed raises rates, i.e., it's not mortgage rates, but they're somehow symbiotic and tied together, the debt that you have on your credit card and on your automobile loan and on your student debt as well, they rise when the Fed raises its rate. Currently, the Fed rate is about 3.5%. Now, on mortgage rates, we get that from the bond market. The bond market is selling debt. Everybody out there who ever has sold debt or knows what that is, well, your basic credit card is somebody selling you a loan. They're loaning you the money to buy something because you're going to pay it off on time, usually at about 20 to 30% interest rates, which are unbelievable. But every time the Fed raises the rates, your car loan goes up and your interest on your credit card goes up. That's what's happening. So the debt load based on credit cards, automobile loans, and mortgages is now at 13 point, what did I say? 13, let's say it's $13.2 trillion. You know, the U.S. economy last year, the GDP was only $16.5 trillion. So the entire debt of the nation is almost what we make, or what they call the GDP, gross domestic product, which is really the sum of goods and services bought and sold in the U.S. during a calendar year. Most people don't understand that that really means when you consider that 3/4 of that number of the $16.5 trillion GDP is consumer spending. So if we're borrowing $13 trillion to spend to pump the GDP, is that a good thing? Probably not a good thing. Now, conversely, as we talked about, there are other things in the economy which look pretty good. Now, we talked a little bit about that. The employment sector is actually pretty good. People going out and getting jobs when they need jobs, getting things to do that pays a weekly check or a monthly check. These things propel people to want to go out and buy more. These are good things. The economy also is reliant upon the stock market. Most of your retirement, anybody out there who works for a public services utility, or you are a teacher. Now, there's a lot of news on teachers in the news. Usually when the economy's good is when we get public service strikes, right? You been following that in Denver?
Yeah, very much so.
Okay, so I have a lot of teachers in my family in Georgia, in Virginia, none in California, but certainly in New York State. A lot of people who are dependent upon those retirement benefits. A lot of those retirement benefit pension funds are tied up in the stock market. Now, the stock market's not doing great either. It's kind of up and down and very volatile. A lot of people nervous about what's going to happen with the economy. So we have two different things happening simultaneously. So it's cooled off the real estate market. A lot of buyers aren't in the market right now that used to be in the market or would like to be in the market. Rising interest rates, although we're going to get to that in our final segment, really the interest rate on mortgages is pretty good. And like I say, we'll get that into news to use section. So if you're out there right now and you're trying to decide, and then you are got a great job, and your spouse or your significant other or somebody in your family also has a great job, and you're looking to pool resources, maybe bring in another family member in order to get that house, the inventory is more plentiful, the prices are stabilizing, they're not rising as fast, and that's a result of more inventory and also people feeling nervous about the economy. But people are nervous about the economy. So if you're out there and you're thinking about it, call me. Let's talk about your particular situation, because in any regards, whatever is happening in the macro, every situation is different. Your situation is different, mine's different, neighbors is different, your family members is different. Your financial situation will be dependent upon your job and the prospects for your future employment. So I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. If you pick up the phone, give us a call. We can help you with your mortgage. You can ask all kinds of questions. You know what? Write the phone number down. Listen to the show. When you've got the question in your mind, call us back, leave a message, and I'll make sure that we get you to the right person. Malibu Funding, who sponsors the show, if you go to their website, malibufunding.net, and go to the loan officer page, there are dozens of very qualified people who would be able to help you if you just don't like me, which is understandable. Not everybody does, right? So anyway, one of the people who is gracious enough to come on the show once again, Jennifer Conrad, is on that page, and we welcome her to the show once again to give us some terrific advice about how to get a mortgage. Jennifer, how are you?
I'm doing well, Jeff. Thanks for having me on the show again.
Thank you very much. Okay, I know you're a bit under the weather. You're a trooper for coming on short notice, too, so I really appreciate it.
No problem.
Okay, tell us a little bit about what is happening right now in the marketplace that you see compared to maybe a year ago.
I'm seeing rates go up, but I am still seeing people are consistently still wanting to buy. Refinance is obviously a little bit slower. And a lot of borrowers, I'm noticing, are wanting to try to move into conventional loans versus FHA. I think the fact that we're having higher loan limits now, too, is probably making people, interested in trying to be able to do the conventional loan. And the fact that we have, the ability to be able to kind of roll the MI into the rate and not have to deal with the monthly MI factor.
Okay, explain that a little bit, because I think some people get lost in our terminology. When you say roll the MI into the rate, what do you mean by that?
Well, anytime you're over an 80% loan to value, so if you're doing a purchase and you're not putting down 20%, or if you're doing a refinance and the value of your home doesn't allow you to have 20% equity in your home, then you would generally have the private mortgage insurance, which is sort of like a guarantee to the lender,
right,
since you're not 20% vested in the property. And in most cases, we normally would have the borrower pay a monthly fee, and it's based upon a factor that, is calculated based on rate, based on credit score, and the full amount of the loan to value in the county. But we have an option to be able to have a slightly higher interest rate that allows us to absorb the cost of that MI in the rate, and it keeps the borrower from having to have a monthly MI. And so a lot of people are more interested in going in that route, and so I am starting to see more people, if they are wanting to do refinances, then they're coming out of an FHA, wanting to go into conventional, having a slightly higher rate to be able to absorb the MI, or if they're doing purchases, it's kind of the same thing. They want to be able to do a conventional, do 3% down or 5% down, and not have that monthly MI.
Okay, excellent. Now, is there, let's say, when you get to 20%, how does one get out of it? You said that some people wanting to get out of the FHA loan and into a conventional loan. How does that work? Is it automatic, or do you have to refinance the property?
No, it is a refinance that is done. Full appraisal is needed, and it's all the standard stuff, pay stubs based upon when we run your loan through automated underwriting. We'll be able to determine if we need to have, just W-2s or if we need to have tax returns. But yeah, it's pretty much a full loan, appraisal included.
Okay, excellent. Now, you're, let's say we're in February 2019, and we probably are going to have a couple of rate hikes by the Fed this year. Bond market was weak, it's strong. Rates actually went down a little bit this week, right?
I'm going to be honest with you. A lot of the stuff that I have been seeing, I've locked it probably prior to everything that was going on this week. So my locks are running at about 4.875. So I really don't know. I haven't looked at it between yesterday and today.
Well, it depends whether it's FHA or whether it's conventional. I mean, what happens with the general economy really affects rates and affects the bond market. In your opinion, the marketplace, the way it is today, do you see much change in the next 90 days or so?
You know, I don't know. I guess, you know, it just really depends on the areas. I mean, like I said, I can tell you what I'm seeing as far as the conventional stuff, and then I'm still doing a lot of the foreign national loans, which in that case, some of the rates have seemed to come down on that.
I see. And in general, the foreign national loans, these are like I-10 products. And
actually, not even the I-10. These borrowers are wanting to invest in the United States, but they don't have a Social Security number.
Okay.
They're not allowed to have a Social Security number. They don't have a work visa or anything like that, but they are looking to be able to invest their money in a property in the United States, and it's usually 35% down. And in that case, you know, a year ago, I was looking at rates that were probably more like 6.5, closer to 7. And I think maybe because there are more lenders that are actually doing these loans now,
right?
You know, they feel like they need to be a little bit more competitive. So I am finding some lenders actually have even these loans with rates in the 5s.
Wow, that's that's low. I mean, if you're looking at investing in the U.S., you need somebody out there who is really versed at doing that. And that would be Jennifer Conrad, and she joins us here today on the radio. Jennifer, you lend in a number of different states, right? So you have some expertise as to the different ways that I guess a loan would be done, let's say in Florida versus California versus Illinois. Can you give some idea as to why that is or if it is?
Yeah, there is a difference. Places like Florida, you know, and like Illinois are considered more of wet states. You got a buyer, you know, and a seller right there at the table. People are very much like, less fun right now. We want keys, money right now. So it's a bit more stressful. Somewhere like California and Georgia, it's a little bit different. We don't have a wet state, so it's more or less, you know, you close. A lot of times you kind of don't even know the closing has happened. The seller's in and the buyer's in, and we have some funding conditions, and then the next thing you know, we're recording the next day. So I find, you know, obviously to do loans like California, Georgia is a little bit easier, you know, a little less stressful than, you know, a state, obviously, that's a wet state.
Do you like doing the non-QM product? I know that there's a lot of push for that just because, as you said, the refinance market has dried up. So people are going into this non-qualified mortgage area. Do you like doing those, or are they more difficult, obviously, than conventional?
They are more difficult than conventional, but I like any loan as long as we can get it approved and closed. So.
Right. No, I'm not saying, I'm not saying that, no.
You know, but I mean, yeah, it is a bit more challenging with the non-QM, depending on the lender. I'm going to tell you, like, I actually have 2 loans with a new lender that we're dealing with, Royal Pacific, and I do find them, you know, fairly easy to work with in regards to doing the bank statement program. So I think it has a lot to do with the lender, you know, and how they are set up, and then, you know, if they have a history of doing non-QMs, because I think if they have been in the game for a while, they try to streamline the process for those of us that are on this end.
Now, most of these non-QM loans have different types of documentation, right? I mean, there's, instead of the full doc loan, which would be, of course, your taxes, your pay stubs, your credit history, they're limited documentation or less documentation or different kinds of documentation.
We do have bank statement programs where, like, you can use your personal bank statements, but we also have business bank statement programs. You know, so if someone is self-employed and let's say they have all of their money going into their business bank statement, you know, then we'll take, you know, 12 months of those deposits at 50%. You know, we need to know that they own 50% of that business. But then
Right.
we also are now in a market where we have some stated income loans, which, we haven't seen in a long time.
Right.
Where some lenders are pretty aggressive, 25% down, and it's a stated loan. So we actually have those options as well.
Well, there are more opportunities, obviously. Listen, we have about a minute left. Do you want to shout out your phone number for those people looking for a great loan officer?
Yes, absolutely. My number is 773-593-6831.
Okay, great. When you are, I hear you driving around a little bit. I know you're a working mom. When you talk to borrowers out there, do you often get a sense that they appreciate the fact that you are also someone who's working, is not sitting up on a high, throne thinking about all your houses and millions, but you're kind of in there with them trying to work out the problems that they also have that you may have also experienced?
I think so. I think, I've been told, by borrowers, they like the fact that, I do take the time to try to make sure I meet them face to face.
Right.
Shake hands, even if it's only a cup of coffee, just to establish that rapport. And I'm very upfront with them, that I have a son.
Right.
And so it's like a certain time I got to pick him up from school, and then I'm, back at work. So I think when people realize, that you're working just like they are, they feel a lot more comfortable to be able to do loans with you.
I agree 100%. Jennifer, thanks for coming on the show. I really appreciate it.
Well, thank you for having me, Jeff.
Thank you very much. It's Jennifer Conrad, loan officer. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. Pick up the phone, give us a call. We're trying to help you decide whether you can afford a mortgage, maybe get a different kind of mortgage, maybe help your real estate agent by giving you a pre-approval letter so that when you go into these multiple offer situations, you've got an excellent chance of getting the home you want just simply because you can afford it and you have the proof from a lender that says you can afford it. I'm Jeff Barton, as I said. If you want to get in touch with me, other than the telephone, info@malibufunding.net, that's my email address. And of course, nobody uses email. So if you want to catch me on Twitter, it's at Jeff6493. The YouTube site, if you go there, Jeff Barton, the real estate voice. And you can see this show as well as hundreds of others that we've done over the last 4 or 5 years. Plus our Las Vegas real estate show, which airs each and every Sunday on channel 28.6. Retro TV. Thanks for listening to the show. I really do appreciate it. On to the show now is a guy that's not been on the show before, but I found extremely interesting when I went to his website as he talked about the relationship between employers and employees and how that relationship dictates how much money you're going to make each and every year. He's got some interesting ideas and thoughts. John Hopper, welcome to the show. Thanks very much for coming.
Thank you for having me. It is truly, truly, truly a pleasure to be on such a big and widely listened to show as yours. I'm truly honored to be here.
Thank you, John. Thank you very much. Okay, the greatest on the planet. Tell me what it is. Well, yeah, I know what it is because I've read about it. But tell our audience what it is and how you see what you can do and help people in terms of improving productivity for both ends.
Yep, outstanding. So it's the culmination of an epic failure as an employer. I have been an employer for 20 years.
Uh-huh.
For 17 of those years, I would put myself at the very top of the list of the worst employers on the planet. And I have talked to people since creating the greatest on the planet who have said, no, I'm worse than you.
Okay.
And here's why we're not good employers. Because being an employer doesn't come with directions.
Right.
We can go out and we can learn our craft really well. We can learn the mortgage industry really well. We can learn the real estate industry really well. We could learn about home appraisals really well. But we don't have anything to guide ourselves on in being employers other than what we learned as we were employers. And those people trained us, and they didn't know what they were doing.
Right.
So we go into the industry that we're in, whether it be a mortgage professional or a real estate professional or whatever we're doing, because we're really good at it. And we're like, you know what, we can do this better than where we're working. Let's just go do this on our own. And then we start walking down the path of business ownership, and we're like, well, we need help. So we go out and we hire people to help us, but we're inexperienced in how to handle those people. So
Right.
we do the best that we can, and the best that we can in today's world isn't going to cut it because we don't know what we're doing. And I can tell you what we're doing. We're doing the same thing we did 200 years ago, or over 200 years ago, when they stepped off the Mayflower.
You know, in an earlier segment, I was talking exactly about this, but in a different context. In that when I was a kid, and I'm 60 plus years old, so a lot of things that we were doing as kids do not have anything to do with the way the world is today, and there's no correlation between the two. What is the effect of that? And that's kind of what you're saying about business and in being an employer.
Absolutely, absolutely. So it works like this. And I'll ask your listeners, to grab a pen and paper, and I want you to write down the offer that you have when you seek someone to come work for you. So you're a mortgage broker, and you're looking for someone to come work for you. You're a real estate agent, you're looking for someone to come work for you. Write down what the offer is.
Okay.
And then ask yourself, would I go work there? And the answer is no.
Right.
I wouldn't go work there myself. So why would I expect anybody else to come work here? What do I offer? Now, when it comes to our customers, we'll go all kinds of out of the way to attract them. All kinds of out of the way. We'll do everything. We'll lay a bed at night. What else can I do for my customers? But when it comes to the people that actually run our business, we don't do that. We don't go, what else can we do? We basically just throw up a sign and we say, we're hiring. Come do what I tell you to do, and I'll give you some money. And here's my argument to that.
Okay.
I can get money anywhere. We live in a day and age of the internet. I can go be a day trader. I can sell Bitcoin. I can create a funnel for somebody online. I can be a coach. I can sell something on my Amazon store. I can sell hemp oil. I can make money all kinds of places. Why would I come work for you? And the answer to that is, I'm not going to.
Right.
So now you own a real estate brokerage or you own a mortgage brokerage, and you're wondering where all the workers are.
Right.
At home in their pajamas?
No, exactly. Well, the day traders are, not people in real estate.
Right. They're at home in their pajamas making money, and you're trying to compete with them. And you're not going to be able to compete with them until you change. And when you change, you can compete with them because you can offer things that they can't. But right now, we're as employers uneducated. So, and I truly believe, I honestly believe this, nobody else on the planet could have done this. Only I could have done it. And I believe I have to do it. I believe it's my calling. And I'll even go a step further than that and say I don't even think it's going to take that long. People are going to look at what I'm saying and they're going to say he's right, and they're going to change.
Richard Branson today, I looked on LinkedIn, had a thing that was talking about increasing productivity and how businesses are customer-centric, customer-focused, and he said, no, be employee-focused. The customers
Absolutely.
will come.
1,000%.
Right.
I'm telling employers to take off your CEO hat, take off your president hat, take off your broker hat, take off all of the hats you think you wear, and I want you to choose one. You're either an employee or you're an employer. You can only be one or the other. Which one are you? And if you're an employer and you start acting like one, your life's going to change.
Mm-hmm.
But we don't want to do that. We don't want to wear the employer hat. We wear the employer hat like it's hidden, like, oh, I got employees here. No, you got to wear that with honor. Mm-hmm. You got to be like, listen, if Santa Claus is coming to their house, it's because I made sure it happened. If Santa Claus isn't coming to their house, that's my fault. If they don't have the money to make their car payment, that's my fault.
Right.
If they don't have money to pay their rent, that's my fault. Right? You have to start owning the fact that you're an employer. And we don't do that. We reach into our toolbox and we say, what do I have to motivate these people? And we take the thing that we have most readily available, which is money, and we dangle it in front of their face and say, come get the money. If you do what I tell you to do, you can get the money. And I argue, my argument to that is, most people aren't driven by money. So it's not a good motivator. And I can prove they're not driven by money because they don't have any. If they were driven
That's
by
true.
money, they would have some.
Right.
But what they do is they take the money that they earn working from you, and they get the things that they truly want. They get groceries for their family. They get a place to live. They get clothes. They go on vacation. They drive a nice car. Those are the things they want. You can get more out of an employee by guaranteeing, I will guarantee you that if you go buy that car, it will not get repossessed. I guarantee it. You go tell an employee that, and they feel the comfort of being able to walk into the dealership and knowing that car is not going to get repossessed. Now you have somebody who's driven.
Okay.
I have comfort. I have protection, right? You don't offer that. You offer you dangle a carrot in front of them and say, come get the carrot, come get the carrot, come get the carrot. They're not interested. That's not the carrot I want. That's the carrot you have available.
Okay.
So,
we have about a minute left. Tell
I'm
us
sorry to hear that.
how to. I know this is hours long, and I'm very wrapped by it. But tell me, someone's interested. You've tantalized. What can they do to get more information from you about this?
The website is thegreatestontheplanet.com. Thegreatestontheplanet.com. They can also search The Greatest on the Planet on every social platform. I'm on LinkedIn. I'm on Facebook. I'm on Instagram. On YouTube. I'm everywhere. The Greatest on the Planet. And it is very important to me that this is affordable. This needs to be something that we can put into the hands of millions of people and change the way it's done. If we don't, you're not going to be able to find a mortgage broker. You're not going to be able to find a real estate agent. The Home Depot is going to be empty of workers.
Right.
Because they can go make money elsewhere. And I believe I can fix it, and I can fix it affordably.
Thank you very much for coming on the show. I want to have you back because I want to continue this, especially, I have a lot of people that I know that would be interested in this. I'm sure people listening have a lot of people they know would be interested in this. And having you back in a month or so to talk it up again, I'd really appreciate it. Thanks for coming on the show, John.
Barely tapped it. Barely
I know.
tapped it.
I know. I know.
We're trying to fix 200 years of mistakes.
I know. Hey, John, thank you very much for coming on the show.
Thank you. I appreciate it.
Yes, thank you. And that's
Goodbye.
John Hopper, the greatest on the planet. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. My name is Jeff Barton, your voice in the mortgage industry, 888-713-2929. That was a great segment. Did you like that segment?
Just let's breathe for a second. Yeah, that was tremendous.
I appreciate people who come on with excitement and ideas. When I first started this show, I was really fast talker. So I appreciate people who can get the ideas out and across. I'd like to know exactly what the secret is. You read The Secret, the book, didn't you, Daryl?
I did.
Okay, I read it too, right? By the Australian writer. I've forgotten her name, but everybody wants to know the secret. I can't tell you how many times I'm on one of those real estate shows on television, and I just want to know what the secret is. I don't want to watch the half hour. Just tell me what the outcome is, or tell me how that person got the house, or got the mortgage, or negotiated the note, or whatever it is that they were looking to do. What is the secret?
Give me the answer first, and I'll decide whether I want to know how to get there or not.
Exactly right. Okay, so there's a bunch of things going on in the economy. In real estate, certainly affecting mortgage rates. Let's get right to mortgage rates. In the news to use section of the show, 30-year fixed rate mortgages ticked down somewhat this week, 4.375%. Yep, you can get a 30-year fixed, that's 20% down, and of course, 740, 750 FICO scores, that's your credit score. But 4.375, that's pretty good when you consider that at the lowest point, 30-year fix was going for about 3.25. So it really hasn't gone up all that much, even though the Fed had raised the rates, I think, 6 times in the last 2 years. As we know, that's a correlation. It's not a direct effect. But at the same time, the way the economy is and how things have been going, the raising of the Fed rates, there is a correlation to the raising of the mortgage rates. So 30-year fixed at 4.375 to 4.5%. That is, of course, the average across the country. That's a very good rate. And if you're out there looking for a house, you need that 20% down, you got that 750 FICO, you can go anywhere and get that because that's the prevailing rate. FHA VA loans, 4.125% to 4.25%. So that is a little bit lower than your 30-year fixed. And those people who don't have the money for the down payment, this is the road to take. The 15-year fixed loans at 4%, 15-year fixed, that's still really, really good. And the 5-year ARMs, 4.25% to 4.625%. Now, the ARM products are usually the lowest rates, but for some reason, at this point, they are not. I guess what it is, if you're looking in the bond market, the Fannie Mae, Freddie Mac, anybody who's buying these type of loans, trying to bundle them together and to sell the bonds or the bundle to different investors, I guess there isn't as much appetite for that as there once was, although the rates aren't horrible. They're usually lower than the fixed rates, but at this point, it's very close, 4.25 versus 4.35. So, yeah, on the higher end, maybe a little bit better, but on the lower end, maybe not so much. Okay, so that's what's going on in the rates out there. Delinquencies in foreclosures. We often talk about, in 2008, how many homes were delinquent, stopped paying, 30 to 60 day late, 60 to 90 day late, over 120 day late. These were the way by which we marked how the economy was doing or what was happening in the economy, what was happening in the mortgage. I know that in San Bernardino and Riverside, for instance, we had 25% of the houses that were underwater, maybe more like 40 to 50% underwater, and 15 to 25% of those were delinquent on their mortgage payments over 60 days. That wasn't all that long ago, 11 years. Anybody who is still struggling to get out from being underwater, who had consistently paid their mortgage on time, kudos. I mean, most people looked at it and said, I'll just walk away, which is what a lot of Americans did. Well, the delinquency and foreclosure rate today is a far cry from that. To the better, right? So if we have a chart, and I'm looking at my chart right now, delinquencies and foreclosures. This is, of course, by our friend Jan Swanson, who I've never met, wanted on the show, emailed several times, love to have her on, but she's busy, obviously, writing these terrific articles. So 30 days or more past due. That means that we are just beginning the NOD, Notice of Default, pattern. There are a lot of laws here in California protecting homeowners from predatory lending or for people who are coming after you to foreclose. However, that number has dropped. In 2017, the rate of delinquencies that were more than 30 days past due was about 5.2%, right? That doesn't mean they're going into default, doesn't mean they're going to be foreclosed on. It just means that you missed a payment. Happens a lot, and according to this chart, 5.2% that year it happened to. Well, in 2018, it dropped a full percentage point, 4.1%. That says a lot. That says that the employment that is obviously at its lowest point ever, as we had mentioned earlier in the show, is a good thing for California. We have a lot of people working, a lot of people being able to pay their mortgages, so much so that we don't have as many delinquencies, 30 days or more, this year. We have 1 percentage point less. 4.1% of all mortgages were late by 30 days or more. And that, of course, is a one-time thing normally. How about that 30 to 60 day late? Well, in 2017, we had 2.2%, a very low number. This year, we had 2%. So it ticked down a little bit, about the same. So let's all go all the way up to 120 days past due. Those number of borrowers in 2017 were 1.5% of nationwide borrowers. And in 2018, it's 1.2%. So again, it's ticked down. Now, the thing we all look at is the foreclosures, right? Anybody who's in the house flipping or who wants to get a good deal. Remember in 2008, everybody wanted a good deal. How do you get the good deal? Where do you go to the bank to get those properties that are foreclosed upon? How can I get in and buy them at 50 cents on a dollar or less? Everybody wanted what they call the tapes. Banks would put out tapes, and they were really the lists of properties that were in foreclosure or foreclosed upon. An REO, of course, is a property that is already foreclosed upon. So let's look at this number. In foreclosure in 2017, 0.6% of all mortgages nationwide. Really low number. That is, I mean, if you consider the amount, dollar volume, and the number of mortgages, 51 to 54 million mortgages each year, less than 1%, 0.6%. Well, in 2018, it dipped even lower. It's below 0.5% to 0.4%. These are some crazy numbers. And again, it has to do with employment. It has to do with the cheapness of the money during that period from 2009, respectively, all the way to 2016, where rates were held artificially low because of the quantitative easing program of the Fed and the Treasury printing a ton of dough to keep everybody happy with the money. Two different competing factors that are changing. Treasury is not doing that, and quantitative easing is lessening. But just for your understanding, these numbers are historic lows in terms of foreclosures and delinquencies. It's a great thing, actually. So let's get into the NAR home price gains at a healthier pace. We talked about it earlier in the show. We don't want to see 7 to 10% increase in the value of your home each and every year. It's unsustainable, it's inflationary, and it just puts people's affordability of homes way out of reach. So what happens? We don't have enough rental market people rental market homes or condos or apartments. So that market gets to be overpriced as well. There's a guy named Lawrence Yuen. He's the NAR chief economist. We've talked about him on the show before. He's a really smart guy, and he comes out with the economic information about what's going on in the marketplace here in California and nationally. NAR is, of course, the National Association of Realtors. The home prices continue to rise in the vast majority of markets. But with inventory steadily increasing, home prices are on average rising at a slower and healthier pace. That's what we're talking about. So if we get this year 3 to 5% rise in real estate prices, that's probably a good thing nationally. It will keep affordability in check. It will probably lessen the incentive for the Fed to raise the short-term interest rates on your credit card and on your auto loan, and all those things mean that the debt would be a bit more under control. We've talked a lot of economics today. Hope you enjoyed the show. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.